Hello everyone and welcome back to my channel SNS Study Station. So today we are going to cover the concepts behavioral finance and second one is what was that financial engineering. Emerging areas, we were learning about emerging areas in financial management. So there were three emerging areas. Risk management we have already covered. Now second was behavioral finance. So let's see what is that. Behavioral finance, that means there finance as well as psychology is involved. Finance is there, that means money is there. Some decisions has to be taken on the basis of money. But how we are taking those decisions? On the basis of our psychology, on the basis of our mindset. Whatever mind says to a particular decision, we are doing that, we are following that. So there are two things, there are two principles of behavioral finance. First one is cognitive bias. That means we have to identify some factors like overconfidence. We have to identify these things because that should not affect our financial decisions. Financial decisions, that means money is involved. We are going to invest our money in something, in some activity, in some investment option. So we have to be careful. Okay, on the basis of only due to less knowledge, we should not invest our money somewhere. So we should not be overconfident. Just by our mind is saying something, this is my instinct. Some people think, no, my instinct is this investment is going to be beneficial, so I will invest in that. So here you are overconfident, don't do that. Then the second one is market sentiment. Okay, some people, they will do research but only for few time. They will see if the market is going up, today the market is going up, okay, now I will invest money because it is giving profits, or on the basis of other persons they are taking some decisions, so that is going to affect their investment decisions. Don't take investment decisions on the basis of others. Do your own research, do the proper research, then take decisions. Then only you take financial decisions, not just by watching others. Okay, now factors affecting financial decision making. There are some factors which affect our decision making process. Okay, what are these factors? First one is overconfidence. Okay, so the thing is that we have already seen, some people have not done proper research. They are confident that this investment is going to be beneficial, so they are investing money in that. Okay, or on the basis of some other factors, they are confident that this is going to be helpful, this is going to be beneficial, profitable, this will not give us losses. So here overconfidence is there. Anchoring means only due to some initial information we are making our decisions. Okay, only few information we have collected, on the basis of that we are taking our decision. We have not collected complete knowledge, complete information we have not collected. Then loss aversion. Some people have this fear that if they are going to invest money in a particular asset, in a particular instrument, then they will have loss, and due to that losses they will be over cautious about their investment, and that time also they can do mistakes. Okay, so just because of loss, just because there is risk of loss, there is fear of loss, it should not be like you should not invest money in that. Read the proper facts, each and everything, read properly, go through that, see the details in the long term. Okay, check the data, check the information, then you put your money in that. Herd behavior means we are following other people for taking our financial decisions. Okay, we are dependent on others. Okay, if the other person investing in a particular stock, if the other person is purchasing, purchasing some security in the market, and he is having profits, then we will think, okay, he is having profit by purchasing this particular commodity, then I will also invest in that. Don't do that. Do your research. As I always say, do your own research. Self-deception, it is also same like anchoring means lack of knowledge. If we don't have proper knowledge about something, so we cannot take correct decisions. Social influence means we should not be influenced by other people for taking our decision. We should do our research. You should not depend on others. Okay, or if the other person is saying, okay, this investment is very good, this asset is very good, you invest in that. Then heuristic simplification comes. That means if you have misunderstood some facts and figures, on the basis of that you are taking wrong decisions. If you have pre-existing belief, okay, then also it is not going to work for you. Emotional influence means emotions. You are not able to control your emotions, and due to that you are investing your money in a particular asset. You have become greedy. Suppose you have invested your money in the market in a particular stock, in a shares, in a particular share you have invested your money and you got profit. Now you are emotional that if I will not withdraw my money, it will again go up and I will have more and more profits, and that is called emotional influence. So these are the factors which can influence our decision making, financial decision making process. Now there are strategies which we can apply incorporating behavioral insights. What are these strategies? Market trends. If you want to invest in the market, first see each and everything in the market. First see the trends, how the market is moving, how the fluctuations are there. Okay, when the prices are going up, when the prices are coming down, it's not like just it is going up and down simply. No, it is also due to some factors, due to economic conditions. Various factors are responsible for market fluctuations. So analyze, understand that pattern, why it is happening. Investment behavior, then understand what is your mind saying about a particular thing. Okay, then cognitive biases, then see all those things, all those factors also you check it, what is affecting you. Okay, don't just depend on those factors, don't just depend on others, don't just depend on what your mind says. First read and understand about the market trends. Then portfolio design, then after your decision, when you make the decision, then design your portfolio, purchase assets, and then assess risk. Risk assessment should be done, evaluate what is the risk involved in that particular investment decision. And then performance review. Then you have implemented it, you have purchased something, you have done risk assessment also, then evaluate when the prices are going up, when you have to withdraw your money, when you have to invest your money again. Okay, see all these things, performance review will be done. Okay, now behavioral finance is also over. Now coming towards financial engineering. What is that? Financial engineering, by engineering, I think you can have an idea that engineering means designing something. What does engineers do? They design either building, roads, or even softwares also they design. There are various types of engineers who design things in their domain. Okay, now we are learning about finance, so here comes financial engineers, here comes financial engineering concept. That means here also they will design something, but that should be related to finance. Means developing new ideas, developing new strategies to solve financial problems, to reduce risk. Okay, or developing new instruments, innovative instruments, design and develop innovative instruments that must have special features. For example, creating new mutual funds with creative features. Okay, designing innovative insurance policies, means they will also design something, but they will do it in a creative way, in an innovative way, and that should be related to finance. Now let's see more things about financial engineering. What is its objective? It helps in reducing the cost of source of funds. From where we are collecting money, what are our sources available? We have to collect the money in less cost as possible. Okay, then reduce financial risk. What are the risks involved? We should try to reduce it through financial engineering. Okay, then avail of tax benefits. What are the tax benefits available? We should try to take benefits of that. Then why financial engineers are needed? So basically they are needed. What is their work? We have already seen they modify old product into a new one. Okay, if any old instrument, old asset, old product, old commodity is there, so they try to add some new features, some creative features in that, so that people will invest in that instrument, and then they made it a new one. Okay, like this they do, or they can find solutions to various problems. So they are needed at the time of mergers and acquisitions. Whenever our company is going to merge with someone else, or we are going to, one company is going to acquire the other one, then they are needed. Whenever trading in the markets, they are needed. Securities and derivatives product are trading is there, so they made new products. And in risk management, obviously they are needed. Okay, now financial modeling. Various financial modeling and engineering approaches are there. There is modeling technique. Mathematical models can be used here, and it helps in investment analysis, valuation of any particular asset, and it helps in doing accurate predictions. Quantitative methods means statistics we will use here. Statistics is used either for summarizing the data, analyzing the data, forecasting. For these things, statistics is used. So we can use it in portfolio optimization to create a portfolio, and for seeing the risk metrics, so it helps in decision making. Risk assessment we can do, we can evaluate risk. Okay, what are the risks involved, what is the quantity of risk, whether that risk is more or less, so we can do it. And then informed, okay, option pricing is there. That means we can use this derivative for hedging. We can protect ourselves from losses, and we can do speculative investment, so there is less possibility of loss, because option trading, if we are doing option pricing, we are doing, that means we are agreeing to buy a particular product on a particular date at the price is already decided, but we have that option whether we will buy on that date or not. So this we can use. Now, what are the practical applications of financial engineering? Last concept, risk analysis. We have to identify, we can identify with the help of financial engineering, we can analyze risk easily. We can have various hedging strategies. That means we can protect ourselves from losses. Again, it is connected to the risk also. We can protect ourselves from the losses that are going to happen in the future. So due to financial engineering, we can do that. Asset pricing, if any asset is there, we can know how to price that asset in the market. Okay, accurately price that asset in the market. Then algorithm trading, there can be various use of technology can be there. Automated systems can be used to analyze each and everything in the market to optimize trading strategies. Okay, and then liquidity management also, we can do it in a good way. So if we want to fulfill our short-term requirements of finance, then it is the duty of financial engineers, you can say. They can tell us, they can produce various new methods and techniques which can help us in managing finance. Okay, so this is all about emerging areas. Now in the next sessions, we'll see about time value of money. It's what is time value of money, and what are the numerical problems also we'll learn. Okay, so thank you.